Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to be talking markets, the momentum to the upside, commodities also continuing to break out, and how bonds and the US dollar fit into this, as well as China and some more tariffs out of the US into a couple potentially key countries that could also be helping drive some of these commodity moves. We're chatting with Marc Chandler, managing partner at Bannockburn Global Forex. Mark, just a kind of broad comment to kick us off is markets. So they're hitting all-time highs, at least the S&P, the Dow's 40,000, that magical number it seems like that just keeps moving higher as markets keep moving higher. But then we also have commodities. Those are breaking out. Gold's back above 2,400. Silver's above $31. Copper over $5. We even had meme stocks going crazy this week as well. Mark, what do you take away from this environment, and what do you think are some of the major drivers behind this environment?
It's quite amazing, huh? It still seems to me that we're in a, that story. I think I might have told it to you before about the guy who jumps off the top of a skyscraper, and as he's falling, he's going past the 70th floor, and he still feels pretty good about things. Past the 50th floor, and still no pain. And I think that's sort of where we are. This is what we think of as a soft landing, which is really a transition period where things do look fairly good. We had news this week. U.S. price pressures eased and demand eased. Retail sales came in weaker than expected, and the March data is revised down as well. Industrial production in the U.S. came in softer than expected as well. And this just removes that argument, at least that tail risk of the U.S. economy reaccelerating, and this talk we had heard previously that the Fed might be forced to hike interest rates.
Well, Mark, when you look at what's happening with interest rates and when you look at what's happening with the dollar, they have moved down, and that's given a little bit even more lift to the markets and to many sectors. But you were noting off mic that some of these may start reversing. What's your thoughts on what's going on with interest rates and the greenback?
Yeah, so I kind of am thinking that the U.S. two-year yield, which is really, it's sort of like rather than looking at just overnight money, it sort of gives you a better sense of sort of the next couple of years expectations. And the two-year U.S. yield got down to 4.70, 4.7% this past week after the retail sales and CPI. And that's sort of the lower end of where we've been for a bit more than a month now. And I kind of wonder whether that's it, that this is the low point for the rates, and we could see the two-year back up, and we've already got it back up to 480. And I think there's not a lot of economic data of market moving significance, and so in light of that, I think we still get that hawkish drumbeat from the Federal Reserve. They want more time before they can cut interest rates, and so I think that if U.S. interest rates firm up a bit from here, and I could see the two-year going back to 5%, that we could get a stronger dollar, and that might weigh on equity markets and in turn also on those high-flying commodities.
But Mark, any sort of weakness or slowdown in this momentum, some of these things have moved so strongly that would that simply just be kind of a short-term natural correction in what still seems like bull markets that have momentum to the upside?
I think that some of the markets are tied to what's going on with the dollar and interest rates, like gold. I think copper is a different story. There, I think there's more structural things happening. China trying to rationalize production, and by rationalize production, reduce smelter activity, try to support prices. I think that what Chad was saying earlier too was there's merit in it that maybe the tariffs that the U.S. just imposed on China and stepped up ones on Russia will have been a factor that may help underpin commodity prices. I think the idea is that China is stockpiling commodities in case there is a broader sanctions against it.
Well, Mark, with the commodities, they are a lot of them a global market. There's a lot of optimism that this is a reflation trade in the U.S. and that other nations are getting out of their funk a little bit. Could it be that because there's things like India that's starting to scoop up a lot of raw materials, and then there's also a lot of growth in South America and Africa? Do you think that it's just a global trend into more raw resources and more raw commodities?
Possible. I'm just suspicious. I tell you, just maybe it's a scar tissue that I think that oftentimes in the market, we tend to come up with narratives that confuse the cyclical developments with structural developments. So maybe there is something structural happening. I do think that there's a cyclical thing happening, and that is as I see the U.S. economic data slowing, the real sector data slowing, European economic activity seems to be picking up. Remember, they contracted in the second half of last year. They showed positive growth in Q4, in Q1, and it looks like they're off to a decent start here in Q2. We'll get the flash PMIs next week. Same thing with the UK. They contracted in the second half of last year, and their first quarter growth surpassed. So they made up for all that ground that was lost. So I think we are seeing that. Japan had reported this past week contracting Q1 GDP, but we already know what the sort of cause was, and that was that earthquake on January 1st, and then that auto scandal. So the economy is already bouncing back. We saw stronger data in March, and it looks like it's spilled over to April. So I think that in some ways, to your point, Shad, that maybe the U.S. economy is slowing down just at that moment where Europe, that's the UK and the Eurozone, getting out of their economic funk, and the Japanese paid the price in Q1, but already looking stronger in Q2.
Mark, what do higher commodity prices do to the economy, to the markets, even to investor sentiment here, where, in all fairness, commodities just don't seem to be on the radar of a lot of generalist investors, maybe because they haven't had this significant of breakouts in at least the larger commodities like gold, like copper, even like oil. We saw oil when it started to move. It brought in a lot more investors, and we saw the stocks really start to move. Also, you can argue probably ticked up inflation. What do you think? Again, markets take away from commodities now having some very significant breakouts.
Yeah, I don't know. I think that you're right. There are specialists stay focused in the commodity space, but I think that generalists keep an eye on commodities broadly as an indicator more about demand, they think, than supply. I think that traditionally, though, oil, other commodities, demand seemed to be steadier. And now we're in a new economic era, maybe a new technology era. If you think about where we are with moving beyond PCs and even the mobility, talking about AI, talking about the energy needs for what this new economy is going to require, whether it's electric vehicles, whether it is just a whole range of AI type things, that the energy that's required is going to place a demand on a lot of these commodities.
Yeah, Mark, that's kind of what I was also getting into with the reflation trade ideas, that the need for electricity and the need to transmit the electricity using copper is spiking things like nat gas, because people are looking forward to nat gas power plants. It's helping the uranium and nuclear story. It's helping other contributing factors like silver that also goes into a lot of wiring and a lot of the EVs. So could that be actually a good sign for the economy, that there's a lot of growth on tap in the U.S. and abroad?
Yeah, I don't know. Like I said, these are like maybe another way to express what I'm trying to suggest here is that there's two types of changes. Those that are sort of like grinds. Typically, we think about the weather or demographics as grinds. And then there's some things that are bumps, like 9/11 or the Great Financial Crisis, things that are like before and after moments. And I think that we want to believe, I mean, as market participants, we want to believe in the bigger story, the bigger narrative. And I still think that this is largely a cyclical story still. And when the dollar turns and the U.S. economy slows down, I think that the ramifications will be like filtered through different markets. I think it's going to mean a weaker U.S. dollar. And that alone could help support commodity prices, even if we didn't have this structural AI story going on in the background.
So much of this also ties into central bank policies, though, right? And now with the markets pricing in one rate cut this year, it seems like we might get that. They actually seem much more level-headed, the markets right now, than when they were pricing in 7 rate cuts not that long ago. But we're also seeing countries like China go down the easing path. They're earlier today announcing that they're trying to save their housing market by lowering deposit requirements. This is a trend that we have seen in China recently because of how weak some of their data has been. How important is, again, the People's Bank of China changing and easing some of their policies, and then other central banks seem like they're going to be following suit sometime this year.
I think you're right. Earlier today we had China gives us like a lot of the macro data on one day. Today was the day, and turns out that retail sales much weaker than people had expected. At the same time, China then announced, as you said, these new initiatives to support the property market. Look, they're talking about a 300 billion Chinese RMB program. That's about $42 billion. Sounds a lot more money than I have, but I think that the problem is so much bigger than that. Just like back into the price of houses and how many they could support and what size inventory, I think they need to increase that like tenfold. But I would say that's just only one initiative, and there's going to be like a multiplier effect from that. But the big thing I think to be looking forward to in China is in July. They have what they'll call the third plenum, which is a big economic, basically a meeting in which traditionally out of it comes economic reforms. And so I think that China is serious about trying to stabilize the housing market, which is a big drag right now on the rest of the economy. I do think they want to increase demand, strengthen the consumer in China. But I also think that we should be prepared for some kind of retaliation, perhaps not right away, like this tomorrow or next week. But I think we should expect some type of retaliation for this last round of tariffs. You know, the funny thing about U.S. tariffs is that even though there's a lot of fanfare made out of them, and the IMF quickly was critical of them, they only cover about $18 billion worth of Chinese goods that are being shipped to the U.S. And the goods being shipped to the U.S. are something like $450 billion last year. So I think that part of the tariffs, I'd say, were symbolic. Part of them were preventative to make sure China doesn't dump their EVs in the U.S. But I think also there's a big role for this for just domestic politics as we head into the election, which is less than 6 months away.
Well, Mark, just one more thought on China. It's the world's second largest economy. It's a big engine of growth. How do you think that some of these wobbles in the Chinese economy could affect things like the resources? How's it affecting things like Chinese equities? Maybe just give us a snapshot of what you think the actual health of China is. Is there an opportunity here for contrarians, or should people avoid the Chinese markets?
Well, the difficulty is that a lot of the Chinese companies that we think are listed in the U.S. as American depository receipts or global depository receipts, it's not really clear always to the investor, the retail investor, what they're really buying, despite what they think they're buying. I want to say that sometimes these ADRs or what look like ADRs are really at an arm's length. What companies that are listed aren't the real parent company back in China. But I do think there's been a change in sentiment towards China. Two ways to think about China. One is the mainland itself, and the mainland stock market, sort of represented by their equivalent of the S&P 500, called the CSI 300, is up about 7%, 7.2% year to date. It's solid. Nothing spectacular, but it's a solid gain after lagging behind many bourses in the early part of the year. On the other hand, a lot of Chinese mainland companies list in Hong Kong. It's more traditionally a deeper, broader market that also got international investors access. And so there's an index called the Chinese Enterprise Index, which are Chinese companies that trade in Hong Kong. And that index is up 20.2% year to date. So I think that reflects not only Chinese, but also foreign interest in some of these Chinese companies. Now that people feel a bit more confident, I think that, yes, U.S. and China, maybe it's the Western Europe, U.S. and China, and some kind of Cold War of sorts, but that Chinese companies are still leaders in many different sectors. People want their piece of it.
I guess so, Mark. It's an interesting environment right here, but taking a step back, do you think everybody right now is a bit too bullish, or is it all founded that I guess we've come out of this, we have a soft landing in front of us, central banks are going to be cutting soon, so why not party in the markets?
Yeah, I think there might be some more life left to the party. Typically, the U.S. does not have a recession in a presidential election year. Also, the stock market typically goes up, barring a crisis. Stock market goes up in presidential election years. That tells me you have another. If the guy from Citibank, Prince, had said about the musical chairs and while dancing while the music's playing, that I think maybe the music plays for another 6 months.
All right, Mark, we'll wrap it up there. Maybe another 6 months ahead of us into the end of the year. Hey, it's been a fantastic run so far, and we're seeing so many other sectors join in. Maybe some of these sectors will just keep on running too. Commodities, it's still early stage for these breakouts. markets have been breaking out for a while, but we've seen that they can carry that momentum through. So very interesting. Doesn't sound like we're going to be looking for a whole lot in the next week or two in terms of significant data that could throw us off, but maybe that's when we do focus back on geopolitics, because there's a lot going on within different countries around the world. Marc, thank you as always for your time. I will post a link to your website, Marc To Market, where everyone can keep up to date on what you're writing about. Marc, I hope you have a great weekend. We'll chat again next week.
Thanks, Corey. Thanks, Shad. Good luck to everybody.